Happy Friday, everyone. Especially good Friday for a couple reasons. I had a cheeseburger yesterday, so that's a good start. But Friday because we've got Labor Day weekend coming up, so extended weekend. It's always difficult because I think everybody's looking for the weekend, but that means that the anticipation is just so incredibly high right now. And I stand between you all and the threshold, okay? And like I said, I take that responsibility seriously, but I've got to teach auditing, so there's a trade-off there. It's a trade-off. We do have like our football players are playing a game this weekend. They're traveling and they're not here today. So wish them the best. I was thinking about this before class. It's like I always make the joke about how when student athletes used to miss before we started recording everything on Zoom, they basically had to catch up in notes and didn't have any backup. And now everything's recorded. It's on YouTube. And I expect everybody to watch it on YouTube. I actually caught a group of students that we were doing a homework review, and I made a joke in class. I said we should just give their points to everybody else in the class, and if they don't object, then we're going to do it. And they were traveling for a conference. I'm not going to name the name of the student organization. Their initials are DSP. But yeah, they were traveling, and I caught them, like six of them. None of them watched the homework review, and I said, I got you, I got you. You know, then a little bit later, another student group, again, no initials, BAP. I did the exact same thing too, and every single one of them were like saying, "No, we don't agree to have our points given away." So yeah, you gotta be careful when you're traveling. I might do something devious like that. All right, so we've got something important to talk about today. Set a foundation for all of our stuff we're going to be talking about. We're largely theoretical right now. We're going to start talking about applications here in a little bit, especially once we get to week 4. But we need to talk about the concept of audit risk. So we're going to be talking about risk assessment today and how it fits in the audit risk equation. Now, let's go ahead and preface this. I'm going to use an audit classroom analogy for how I am going to approach this. Um, Dr. Caden is going to come and evaluate my performance at the end of the semester, and she's going to try to determine whether I did a good job. And I've made the joke that I make a lot of comments about my evaluations, but she will evaluate what you all give me what your score you give me for the class, and use that as part of the analysis. So you hold my life in your hands, okay? And I'm taking my responsibility seriously. You all have to take your responsibility seriously too. But I'm going to talk to her, and she's going to say, "Do you think the students learn anything?" And I'm going to say, "Yes, they know everything they know about auditing. My students are very knowledgeable." Is it possible that I can make that contention and I could be wrong? Yes, it's very possible, especially given how goofy I can act at times and not necessarily focus on auditing as well as I should. Well, it's also possible that I could do my job. I could teach really well. I could do the application. And for some reason, my students leave the classroom and I feel like they know they've done well in the exams and they learned the material, and they could basically forget it all over Christmas break or over summer break. And so there's certainly problems with that. So I could do my job effectively and still not accomplish what I want to accomplish. So that's always a risk, is that even though I make that contention, I could be completely wrong. And this concept, if we think about it from an audit perspective, is very similar to the idea of audit risk. Okay. Now, audit risk by definition, the way that's defined in the book, is the risk the auditor expresses an inappropriate audit opinion when financial statements are materially misstated. And we can probably characterize that inappropriate opinion as being a clean audit opinion, unqualified or unmodified. In other words, the auditor says the financial statements are fine. They are free from material misstatement when in fact a material misstatement exists. That is the risk, audit risk. If you've ever taken a science course, you've probably heard of type 1 and type 2 error. This is a classic example of type 2 error, saying something is fine when in fact there's a problem. Okay. That's a big issue, by the way. If we're talking about that, if we talk about a really heavy scientific disciplines, type 2 errors are just basically where people get into or people put into peril. If, like in healthcare, you say everything's fine and there's a big gap, there's a problem. Now it's certainly problematic from auditing, maybe not that big a problematic, but we've seen some chaos reign as a result of this. The example that I like to use, Enron, it's 23 years gone, and we still use it as an example in auditing. That's where the auditor said, "Hey, everything's fine." And in fact, their financial statements were misstated by billions of dollars. And so chaos reigned and the economy took a hit and everything was problematic. We've got lots of examples of that. So there can be very substantial impacts when auditors make a mistake. That's why I like to say, We have an unqualified opinion plus materially misstated financial statements. That's where we have, let's see if it's going to work. Oh man, the GIF's not working. Okay, there's a GIF here, which the planet explodes. Okay, which is a little bit dramatic. It basically it doesn't really work if the GIF doesn't work. Okay, and I checked it before I would go into class. It worked on my computer, so it's this computer's fault. Okay, but yeah, imagine the world exploding. That's how you should think about audit risk: is that we have financial statements and we have problems. Now, obviously, we already talked about this concept of reasonable assurance, and we can't prevent everything bad that could possibly happen. So we want to do our best to limit the range of possibilities of bad things happening. Now, the way that we approach this from a financial perspective is we consider the nature of assertions, which we've already talked about from management assertion perspective. So these are express or implied representations by management, hence management assertions, regarding the recognition, measurement, presentation, and disclosure of information in the financial statement. In other words, every line item on the financial statements is represented by an implicit assumption that made by management about the nature of that particular financial statement item. Now, as we're going to see when we get to chapter 5, different financial statement items have different assertions that are characteristic associated with them. The one that we've already used as an example is a very transparent example. It's the one that I'm going to use again for this particular session. So financial statements contain an account balance of $30 million for inventory. Management's representing that the inventory exists and is properly valued. And we've talked about what that is, how we actually would test that as auditors. We would go look at the inventory, say, oh, look, inventory exists. And we look at the paperwork underlying the purchase of that inventory and say, all right, the money that they have it on the balance sheet for is consistent with what my expectation would be. So existence, occurrence, valuation, allocation, accuracy are both going to be tested in that regard and evaluated in that regard. So again, understanding the nature of assertions is not as important right now as it will be in chapter 5. But the reason that we bring this up is that we consider audit risk at the assertion level. All right, at the assertion level. And at the assertion level, audit risk consists of it's 3 components, but it's going to be broken down into 2 primary components. Okay, so 2/3 components, depending on how you want to characterize it. Okay. The first of the component is going to be the risk the relevant assertions related to financial statements contain misstatements that could be material to the financial statements. So I want you to write down next to this, and this is in the slides, but I want you to write down next to this. This is called the risk of material misstatement. And the risk of material misstatement contains 2 components: inherent risk and detection risk. Now, don't worry, we're going to get into a lot more detail as to what these mean. You're going to be sick of it by the time this lecture is over. You're going to be saying IR, DR, AR, who cares? All right, that's fine. It's going to be very overwhelming to kind of segregate these or separate these concepts out. But for right now, we're just going to say risk of material misstatement is inherent risk and control risk. Now, the other component of this is the risk that the auditor will not detect such misstatements. This is called detection risk. So basically, we've got 2 risks, okay? The financial statements are misstated, and the risk the auditor will fail to detect such a misstatement. That's how we consider that. And like I said, we consider this the assertion level. The assertion level is characterizing the financial statement line items by their native assertions, what it is we're concerned about. As we're going to see in chapter 5, some assertions are less relevant than others for certain line items. Like a good example of this is rights and obligations is one of the assertions we talked about. That is generally not an assertion that we concern ourselves with for cash. Why? Cash is a bearer instrument. Whoever holds the cash has the rights and obligations to use it, okay? So we don't really worry ourselves about that. But existence of inventory is a very big assertion because many financial statement frauds that have occurred in the past have overstated inventory, basically said we bought inventory that we didn't actually buy so we could inflate our financial statements. So that's why we characterize according to the assertion level. All right. Let's go ahead and break down these concepts that we've talked about already. All right, we broke down these concepts that we talked about already. So let's go and talk about inherent risk. Okay. Now, inherent risk is defined as the susceptibility of an assertion or account balance or disclosure to a misstatement due to error or fraud that can be material either individually or aggregated with other misstatements before consideration of any related controls. In other words, these are fundamental risks to the entity's operations. Now, I'm going to go back to my audit classroom analogy. Is there a reason why you might fail to learn auditing effectively in this classroom? I mean, You could say, no, Dr. Barnes, I absorb everything like a sponge. And if that's your attitude, good. All right. I'm really, really excited about that. But are there impediments to that? Certainly. Okay. There's a whole lot of information about auditing. Okay. I'm not going to cover everything that you need to know about financial statement auditing in this course. We're going to cover a lot of it, but there's a whole lot that we're going to jump over just simply because it's so consuming. I mean, it's just a lot of volume of information. Also, it's constantly changing. There's a lot of information that what I taught it when I first started teaching this 10 years ago is inconsistent with way things work nowadays. And another impediment, let's be honest, sometimes this can get a little bit dry and tedious, get a little bit boring, okay? All right, you're going to hear me call out Tommy's cousin a lot, okay? Because Tommy's cousin, a former student of mine, and there's a joke I usually make at his expense where he was sitting in a classroom during the spring, okay, during the spring semester, and it got a little bit warm. It was actually in the 1408. So everybody had been in 1408 before. During the spring semester, it can get a little bit warm in there. So basically, students would start nodding off. It's like right after lunch. It's, hear the nice quiet tone of my voice and just basically just kind of like want to take a nap. He was notorious for basically taking power naps. So he would basically be sitting there and then his eyes would close for like 10 seconds and they pop back open again. Okay. Did he ever tell you that, by the way? That's something you could hold against him. Okay. All right. Something to hold against him. I've used that example in many discussions. I've never actually said who it was, but now you know who it was. And if anybody knows Tommy Cousin, now you know who it is too. Okay. But yeah. So by the way, if you never take a power nap, you will be one up on him. You'll actually be one tier above him in my favorites book. Okay, so that's going to be the goal. All right, it's actually a joke. There's a lot of jokes there, but former students. But that's one that sticks up. It can be tedious. It can be boring. I teach the class. I've taught it for 10 years. Even I can't avoid that. The way that Alan Davis used to characterize it, he said, auditing is really boring. And I would snap back and I would say, yes, it takes an exceptional instructor to make it interesting. So there we go. That's how we do it. All right. So certainly problematic. Now let's go ahead and flip this. Are the reasons in an organization why an organization may have misstatements associated with their operations? Certainly, okay. High volume of transactions. They could have complex tasks and calculations. They could use a lot of estimates. Estimates are really problematic, and it's something where we try to make an objective measurement. Estimates create problems for that. Risk of technological obsolescence. We're going to talk a lot about that in this course. Does technology become obsolete in this day and age? Yeah, you like exhale and all of a sudden your iPhone is now like 5 models behind, okay? Like I bought an iPhone X and I thought, wow, this is one of the bunch of like iPhone X was like 6 years ago. I had to buy a new phone recently because my iPhone X no longer works. All right, working capital concerns. We don't actually collect enough money on our income in order to be able to operate. Increased business risks. Is cybersecurity a thing nowadays? Cyber attacks are kind of on the rise and prevalent. Security risks are certainly problematic. All of these represent risks to an organization, okay? All of these are problems that have to be addressed. So a lot of business risks that are present just by being in business. Just the nature of going into a business means you're subject to certain risk. It's not something you can avoid. It's the way it works. All right, so we know risks exist, but we also know there are things that we can respond to. We can respond to risks with, what are those things called? Controls. Yes, you all remember from AIS. Controls are a response to risk, okay? So what about those controls? Those controls can be very effective, but is it possible the controls themselves could fail? Certainly, okay? So then we have this concept called control risk. The risk that a misstatement could occur in assertion about an account or disclosure that can be materialized individually or in aggregate with other misstatements will not be prevented or detected and corrected on a timely basis by the entity's control. In other words, risks that are still present after an entity takes action to address its inherent risks. So I said that there's a lot of volume, okay? There's a lot of volume in this course that it can be a little bit boring and be like constantly changing. So I have certain controls in this class to try to ensure that even though this is dense content, that you all are learning it. What are some of my controls? Homework assignments, lectures, exams. Okay, those are all examples of controls that I've implemented to try to mitigate that risk. Is it possible that even though I've got these controls present, that they could not work? Certainly. Everybody knows I like to ramble. What was the very first thing I said when I talked about class today? I didn't talk about how great auditing was. I said, I had a cheeseburger last night, okay? I love to tell stories that are not relevant to auditing. And you can be like, I was trying to learn about management assertions. He kept talking about cheeseburgers. I don't know what the heck was going on. It's the weirdest thing. Or I could give you exams or homework that's kind of completely irrelevant. Okay. So what are two categories? Let's talk about two categories of this. First thing, I could fail to give you homework or assignments. All right. I failed to give you homework or assignments. So you have no chance to actually learn this content. Another possibility is I could give you homework and assignments, but they're completely irrelevant to the content I give you. It says you have a homework assignment. It says, okay, do homework problem number 1. What is Dr. Barnes' favorite food? What the heck? That doesn't teach you anything about auditing. Okay. It teaches you a lot about Dr. Barnes, but you don't really need to know that in the real world. Okay. So those are two categories of failures that we could talk about. Those are going to be consistent with that idea. When we think about controls, what we're concerned about is, has a control been implemented? And if so, is it going to be operating effectively? So there's going to be two concerns with controls. Controls have been properly implemented. If that's the case, if a control has not been properly implemented, we refer to that as a deficiency in design. Control has not been properly implemented. And this could mean a number of things, okay? Deficiency in design. It can mean the control has just never been implemented. It's never been present. Or the control is present, but it was created incorrectly. All right. So the controls are properly implemented. That's our first concern. The second thing is the control is implemented, whether it's effective. If a control is not effective, we can call that a deficiency in operation. Deficiency in operation. So you've got a control, you've got proper segregation of duties in a certain area. You guys remember segregation of duties from AIS, CAR? We're going to get into that, I promise, okay? But you got proper segregation of duties, but the 3 people in that area says, it is so time consuming for each of us to have to do a certain responsibility area. If we just gave all the responsibility to one person, it would save us plenty of time. So the control is present, but it is not functioning properly. People are ignoring the control. That is a deficiency in operation. So that would be an example of that. By the way, I do want to point something out. We talked about this in AIS, but I want to reiterate this point. Generally, when we characterize controls, they're going to be in one of two category areas. And this is referred to in this blurb right here, this blurb. They're going to be preventive or preventative, depending on whatever word you want to use, or they're going to be detective and corrective in nature. So a control is either going to prevent a problem from occurring, or if a problem does occur, it's going to detect that problem and fix it. It's going to correct it, okay? That's how we need to think about controls moving forward. And trust me when I say we will have a lot of discussion about controls because auditors have a responsibility related to internal controls. Now, there's something interesting going on with these two concepts, inherent risk and control risk, is that these are combined called the risk of material misstatement, okay? So you kind of see your auditor standards refer to the combination of inherent risk and control risk as the risk of material misstatement. And that goes back to that definition from a few slides ago, is that the risks are present. So a risk is present by very nature of the fact, or a misstatement is present, I should say. A misstatement is present. It has to do with the fact that risks exist and that a control has not properly addressed those risks. What's interesting to note is these are functions of the entity and its environment. So what does that mean? It means that the client, our audit client, is the one responsible for these risks being present. Now, one of those responsibilities is the fact that they started operations, and because they start operations, these risks suddenly are exposed. You started developing developed a business where you were going to be in smartphones. Okay, you're going to be manufacturing smartphones, and all of a sudden you have this risk of high competition because you're competing against Nokia and Apple and Google and all these other companies doing the same thing. Plus, you have this risk of technological obsolescence, and you got supplier and vendor concerns. Just by going into that line of business, you create risks. That's our inherent risk. And the control risk exists because we as a client have a responsibility to address those risks. We have to put controls in place. The auditor has little to no control over these risks. Effectively, no control over these risks. We can't actually exert any influence over inherent risk or control risk. And this is extremely important. This is extremely important because we're going to characterize audit risk according to its components. And these are two of the components. So what this means is we can assess what we believe inherent risk and control risk are in an organization, but we cannot influence it. We can exert some influence a little bit later on, like we test controls, and we say, wow, this control is really, really bad, we should tell the client they need to fix this. That is after the fact control or after fact influence, and it generally does not affect current period. So minimal influence by the auditor. All right, so we've got our two concepts down, a risk and material misstatement, but there was a third, okay? There was this concept called detection risk. All right. Now, detection risk is the risk the procedures performed by the auditors to reduce audit risk to an acceptably low level will not detect a misstatement that exists. Could be material or individually in aggregate with other misstatements. In other words, any remaining risk after audit procedures, after planned audit procedures. So going back to my classroom analogy, I'm going to do something I always enjoy doing. I'm going to turn Dr. Caden into an auditor. Okay. And I know she would hate that if she were here right now. I think she's actually sat in a class, like doing a peer evaluation where I made her an auditor, and she just kind of shifted uncomfortably in her chair. Okay. So Dr. Caden is going to actually evaluate my performance. She's going to read those evaluations, and she's going to do testing her own. She's going to talk to students. So how did Dr. Barnes' class go? So, oh, I learned a lot. Okay. Did you learn a lot about auditing or cheeseburgers? Then you're going to have to sheepishly say cheeseburgers. Yeah. But yeah, she's going to actually evaluate this whole process. And depending on the scope of work she does, she's going to come to a conclusion. And sometimes her conclusions could be right. Dr. Barnes is doing a good job, or it could be wrong. Dr. Barnes is doing a good job, when in fact, I'm just doing a miserable job. Okay. So she could actually come to the right conclusion or the wrong conclusion. The risk that she could come to that wrong conclusion is this detection risk. It really depends on the scope of the work that she performs. Okay. So putting this in an audit context, detection risk is determined by the effectiveness of audit procedures and how well the procedures are applied by the auditors. So we are going to look at inherent risk and control risk, and we're going to make a determination. We're going to say, we need to do a certain amount of work in order to be relatively certain that the financial statements are free from material misstatement. If we fail to do that level of work, then we expose ourselves to a larger risk of material misstatement. So we need to make sure we do enough work that we're reasonably certain. All right. Now, it's important to note, remember I characterized risk and material misstatement, those two components, inherent risk and control risk. I said these cannot be controlled by the auditor. This is the only component of the audit risk model that the auditor can control, detection risk. And the way that they do that is they actually exercise their judgment in how much work has to be done from a substantive perspective. Now, there's a lot to unpack here. We've still got a lot more to talk about, but I want to actually include one more thing that we're at the concept. This is something that's related to the audit risk model, but external to it. You're going to see a lot of discussion about this. This is this concept of engagement risk. Okay, engagement risk. Okay. In addition to audit risk, auditors are subject to engagement risk, which is the risk the auditor exposed to financial loss or damage to his professional reputation from litigation, adverse publicity, or other events arising in connection with audited financial statements. Engagement risk cannot be directly controlled by the auditor, though some control can be exercised through the careful acceptance and continuation of clients. Now, what does this mean? It means that generally speaking, we need to be very careful about who we accept as clients, because the nature of those clients could be detrimental to us if they were exposed to somehow. Often this can come with an audit failure, but it could just be being associated with a particular client that has high risk associated with this. Now, this is an old example, but this is the most compelling one. And I apologize for using this particular example, but I have to go with an extreme example to kind of explain what this concept means in its purest form. All right. Everybody familiar with ever heard of the accounting firm Grant Thornton? Okay, Grant Thornton is a regional accounting firm. They're not one of the big four firms, but they're a large national, or not a regional, they're a national accounting firm. Fairly large firm. They do hire pretty consistently for Trim Estate. So Grant Thornton, a few years ago, they decided that they were no longer going to keep on a company called MindGeek as their client, okay? Now, it's unlikely that you've heard of MindGeek, but they are the parent company of a very well-known website, okay? I'm not going to tell you the website name except to say that it is a hub for adult content, okay? Now, if you can't figure it out from that, okay, good for you. First of all, good for you for remaining innocent, okay? But we'll just say it's not a savory place for young, impressionable students to go to, okay? I hope that you don't spend a lot of time there, but even if you've heard of it, okay? The idea being is that because of the content that this particular website produces, and because MindGeek is the parent company of that, they did not want to be associated with that particular business model. Now, without going into detail, there's a lot of other things to unpack there. There was a lot of concern about abuse and some conduct activities that was exposed to this particular website that has come out in the media. That was also kind of spurred on Grant Thornton's decision. But this is a pure example of engagement risk. They made the decision that because of this particular client, the nature of the activities, they did not want to expose themselves to the risk of that particular engagement. So they decided to no longer perform the audits for that client. So kind of an extreme example, but a very, very obvious one nonetheless. That's an example of engagement risk there. All right, let's talk about the audit risk model. So even though we don't do a lot of math in this class, I do want to characterize this particular concept through an equation, okay? We can say that audit risk, the risk of the financial statements are, the auditor expresses a clean opinion on the financial statements when materially stated, can say that it's characterized by a functional representation of the three concepts we've talked about before. So risk material misstatement and credit, or sorry, detection risk. I don't know why I said credit. Detection risk. Also, or audit risk is a function of inherent risk, control risk, and detection risk. You know, it's funny. I've been teaching this class for 10 years. I've never actually looked and see CR and DR because those are credits and debits. And it's like, that's never just occurred to me, which, but yeah, in this context, it means control risk and detection risk. Okay. Control risk and detection risk. So this model expresses the general relationship of the audit risk to the auditor's assessment of risk and material misstatement and the risks of the auditor's procedures will fail to detect a misstatement or relevant assertion. So in other words, audit risk is effectively a function of whether a misstatement exists and whether the auditor fails to capture or detect that as a misstatement. So that's basically what this is represented right here. Now we're going to dig down a little bit deep. Something I want to share with you is kind of something that I like to talk a little bit about with how we think about these concepts. So first of all, we're going to talk about audit risk. Audit risk in general is constant. When we think about how an auditor sets audit risk, they're usually going to set this at a fairly low level, either low or lower, very low, low or low, very low. So we can think about audit risk as a constant, okay? And that's going to be very important for when we actually start making determinations a little bit later on. Another concept is that I like to tell people that how we actually characterize risk and material misstatement is contingent upon how we characterize inherent risk and control risk, which everybody says, well, that's obvious because those components of risk material misstatement, Dr. Barnes. And what I specifically mean is that once we determine the lowest level of one of those two, that is what we were set risk and material misstatement at. And this is a little bit controversial because everybody would naturally assume, like, if I set risk and material misstatement, or sorry, if I set inherent risk at high, I set control risk at low, everyone would say, well, let's just take the average of those two, and then control or risk and material misstatement has got to be moderate. And I contend that's different, okay? That actually, if risk and material misstatement is high and control risk is low, inherent risk is high, control risk is low, risk and material misstatement is low. You set it according to the lowest level. And I've made this argument now for many, many years. I want to explain my argument, okay? So let's use a visual example to talk about this. This is my favorite club in Kirksville, Club RMM, okay? Club RMM, spinning the tunes with DJ Double I, because this is what Dr. Ison, one of his entrepreneurship gigs, okay? So we've got two bouncers, two doormen, I should say, to give them a better title, two doormen, Irving and Craig, IRVING and CRAIG. Everybody see what I did there? Okay. So they're responsible for letting people into the club. They've got to use some judgment in doing that, just like you all have to use professional judgment in your assessments. So let's say that they decide to let in 50 people per hour. Both Irving and Craig let in 50 people per hour. So 50 people coming through this door, 50 people coming through this door. How many people are going to get into the club section per hour? Be 50 people, okay? Because 50 will flow through this door, and then another 50 will flow through this door, and those 50 people hit the club. So as long as those are consistent with one another, then we're fine, right? But let's assume that one of the patrons really upsets Craig, okay? And he says, you know what? I'm only letting one person in an hour because I'm sick of this, okay? So Irving is still letting in 50 people, but Craig only lets in one person an hour. How many people are reaching the club? One, okay? One person an hour because Craig has got influence over that. All right, we'll flip it, okay? Craig finally chills out and says, okay, I'll go ahead and let 50 people in an hour, okay? Now, again, you have to suspend the assumption that there's people in the waiting area already, all right? So assume there's nobody in the waiting area, but Craig says, I'll let in up to 50 people an hour. Irving's just like, these people are ridiculous out here. I'm only letting in one person an hour. How many people reach the club? One, okay? So this is dictated by the lowest number established by one of the doormen. Same concept holds for risk and material misstatements, okay? This idea of RMM that we're talking about. So if I have a client that has got high, tremendously high, ridiculous inherent risk, okay? Like we think that they've got all these risks associated with them, and so there's going to be problems associated with their financials and high chances for misstatement. And then you go in and you look at their controls and you're just like, these are the most beautiful controls I've ever seen. I am so happy with these controls. These controls could capture every misstatement that ever existed on the planet, okay? Does it matter that inherent risk is high? No, controls are fantastic. So we can say control risk is low, risk of material misstatement is low. What about if controls are non-existent? Okay, so we go and we do an audit and we say, where are your controls? It said, controls, we don't need those. So say, why don't you need controls? It's because we have zero inherent risk. That's not likely to exist, okay? But let's just assume that you do look at it and say, that's really weird. That's true. They're the only company that operates in this business. They've got stable business model. It's not changed in like 30 years. Inherent risks are non-existent here. Does it matter that control risk is abysmal? No, because they don't need controls. They don't need controls because inherent risk is minimal. Now, by the way, I just want to make a note. It is extremely unlikely we'll ever encounter a scenario. I know not in this course, but it's extremely unlikely that you'll encounter a scenario where inherent risk is low. Inherent risk is almost always high, just simply because we're dealing with large businesses. Even small businesses have generally high inherent risks. That being said, theoretically, we could actually dictate risk and material misstatement being a function of inherent risk and control risk. And this is kind of the idea behind that. All right. Let's go ahead and drill down a little bit more in the audit risk model. So like any equation, we can mathematically rearrange the components to solve for one of the components. So instead of solving for audit risk, because that's not really the one that we want to focus on, we want to solve for detection risk. Now, what did I say about detection risk? Detection risk is the risk that the auditor will fail to detect a misstatement. We can actually change detection risk. We can influence detection risk by actually changing the nature of our testing. So it behooves us as auditors to know what detection risk is. So if we actually do the mathematical rearrangement, we've got in the numerator audit risk and the denominator detection risk. So purely speaking, detection risk varies directly with audit risk and varies inversely with risk and material misstatement. Now, that seems really, really complicated. Let's make this a little bit more simple. What did I say about audit risk? What did I say? A couple of minutes ago on the previous slide, I said something about the nature of audit risk. What did I say? Is it a variable or a constant? It's a constant, okay? So if audit risk never changes, we don't have to care about detection risk with relationship to audit risk because the audit risk is not relevant. So remember from math, if you've got a constant, because it's a constant, it will always be the same. You don't have to actually map out that relationship. See, the only relationship we care about is detection risk's relationship with the risk and material misstatement. And we said that's an inverse relationship. So what does that mean? It means that as risk and material misstatement goes up, our detection risk goes down. And as risk and material misstatement goes down, detection risk goes up. Now, the implications for that are not obvious and they get very confusing, but I want you to just make a note of that, okay? That there's an inverse relationship. Now, usually speaking, when we talk about the audit risk model, we tend to characterize these terms in qualitative terms. Can you actually use this in numeric terms? The answer is yes. Generally, you have to use percentages because the math gets wonky if you don't. But for the most part, you could do this in quantitative terms, but it's easier to do it in qualitative terms. So let's go ahead and do some really quick examples. Audit risk, as you notice, is a constant. It's low or very low, so we can largely ignore that. Instead, we're going to say risk and material misstatement. If my risk and material misstatement is moderate, what is my detection risk going to be? What's the inverse of moderate? Moderate. Yeah, it's also moderate, okay? Because remember, you got a sliding scales. One goes up, the other goes down. If this is right in the middle, so is this right here, okay? Audit risk is very low. Risk and material misstatement is high. Detection risk is going to be low, okay? Low. And again, we're going to discuss the implications for that in just a second. Audit risk is low. Risk and material misstatement is low. Detection risk is high. Detection risk is high. And then we've got the same thing in number 4 as we had in number 1, moderate. It's going to be moderate, okay? Now you could make some argument that audit risk is varying a little bit here. Does that affect detection risk? The answer is maybe a little bit. Largely speaking, no. Most of our focus is going to be what we believe risk and material misstatement is, and that's going to be our focus for this course. Risk and material misstatement dictates detection risk. All right. Let's go ahead and discuss what this means, because this is the takeaway right here. By the way, when I first took auditing, my instructor did not explain this well, and I was completely and totally baffled by this whole concept. It is very confusing, but I'm going to give you some tips to actually help you understand this. So detection risk represents the level of risk that the auditor is willing to tolerate with respect to its audit procedures. So we know that it's inversely related to our risk and material misstatement. That means it's also inversely related to the strength, detail, and quantity, or the nature, extent, and timing, net, of evidence the auditor needs to collect. So what this means is, if I say that I am the auditor and have a high detection risk, I'm effectively telling you I can tolerate a high amount of risk. Now, this is confusing because if we hear the words high detection risk, you normally think, well, that's bad. High risk is bad, okay? High detection risk is not bad. It's actually the opposite. It's very, very good because we can tolerate a high amount of risk. On the other hand, if we say low detection risk, generally we say low risk, that's a good thing, right? No, we hate low detection risk because that means the auditor can only tolerate a small amount of risk. It's very confusing to use that term detection risk and say detection risk is low, detection risk is high, because our native assumptions are when we hear high risk, we say bad, low risk is good. It's the exact opposite for detection risk. But if you think about it from an appetite for tolerance, it makes a little bit more sense. So let's go ahead, and I'm going to lead you on here. And I don't have this all on the slide, but I want to think about some native assertions that are associated with this. So I say, right, my risk and material misstatement is low. All right, my risk and material misstatement is low. I've actually done the testing of the controls, and I found the controls to be very effective. So I set risk and material misstatement as low because controls are good. That means my detection risk is going to be high, okay, because we know that that's inversely proportional to detection risk. What is that saying? It means that I have a high appetite for risk. I can accept large amounts of a large chance of misstatement because the controls are likely to capture any misstatements that exist. The controls are so good. So I don't have to worry too much about my testing. What does that mean for the work that I have to do at the end of the audit? Very minimal. My nature, extent, and timing is low. So control or risk and material misstatement is low, detection risk is high. My scope of procedures at the end is going to be low. Let's think about it from the other perspective. I test my controls as an auditor. I conclude the controls are not effective, okay? Inherent risk is high, control risk is high, meaning my risk and material misstatement is going to be high. Now, just flat out, logically speaking, if you're an auditor and you go in and say, wow, there's high risk and material misstatement, are you going to be happy or sad auditing that client? You're probably going to be like, oh my gosh, there's so much risk here. I'm going to have to do so much work. And that's what that's telling you, saying risk and material misstatement is high, detection risk is low, okay? Detection risk is low. We have a low appetite for risk. We cannot tolerate very much risk. Therefore, we have to do a lot of work. The nature, extent, and timing of our work is high, telling us that we've got a lot of work to do ahead of us to make sure that we capture everything. This is one of the more confusing points. If you get this down, this chapter is much easier. It's really important to understand these concepts. It's also really, really important to understand the relationships, okay? It's not enough to say inversely related, go on. To understand these concepts intuitively is much more beneficial to say, all right, I understand why risk and material misstatement might be high. It's because controls are not effective. If controls are not effective, I probably have a lot more work to do as an auditor. That's basically what that last line is telling us, what this line is telling us down here, okay? Understanding these concepts really, really important. So understanding how RMM affects detection risk and how detection risk affects our work. Now, I do want to make a note of this because it's a little bit confusing since we haven't gotten to the phases yet. These generally align with the phases of the audit that we've talked about and we alluded to back in chapter 3. Remember back in chapter 3, I said we've got our planning phase, then we've got our risk assessment phase. So risk assessment is going to say our preliminary assessment for what we think inherent risk and control risk are. We will refine our assessment of control risk when we test the controls, which is the next phase. Okay. So we test controls, we say, oh, these controls are good or these controls are lousy, whatever it is, we can make a final assessment of control risk. That allows us to conclude on what we believe risk and material misstatement is. Then does anybody ever remember what the next phase was, what I categorized that as? Substantive procedures, okay? Substantive procedures is basically our last testing phase. That is where we look at risk and material misstatement and we say, how much work do we have left to do? And that's where we evaluate detection risk. That's what's going to dictate the amount of work we have left to do. Now, if you're not completely and totally sold on the phase yet, if you don't completely have that down, don't worry. We still got one more full chapter, and that's going to focus very heavily on the alignment of those phases and their relative risks. That at this point right now, you should be thinking in phase terminology. You should be thinking, okay, we're in risk assessment. After risk assessment comes test of controls. After test of controls comes substantive procedures. Then we issue our opinion. That's how we should be thinking about this moving forward. All right. So to properly assess the risk of material misstatement and engagement risk, auditor needs to understand management's objectives and strategies and the related business risks that may result in material misstatements. Now, I bring this up because business risk is not necessarily native to audit risk. It doesn't completely define inherent risk, but it is very closely related, okay? Most business risks have the potential to affect financial statements either immediately in the long run. So these are concerns that we will generally have to consider when we consider the inherent risks associated with an organization. So the reason this is a big difference is because business risk is very broad and it kind of occurs over a long time period. When we think about an audit is usually constrained to one period of time, usually the preceding year or something along those lines. If we're talking about an annual financial statement audit, is exactly the preceding year, the preceding financial statement year. Whereas business risk is going to be a long-term concern and can affect different components of the audit risk model. So your business risk, I want you to think about, okay, what does that do to my audit risk model? Probably most directly, what is this going to do inherent risk? We're going to talk a little bit about business risk for our homework for chapter 4, but keep in mind that it is a much broader concept. It's not inherent risk altogether, but it will affect inherent risk assessment. All right, I'm going to put this up here because I think that this is important to note. We are in a risk assessment, and one of the things that I like to say is that there are phases of the audit, and then there are also phases in audit testing. So just to understand what we mean, okay, phases in the audit can be very, very broad, very, very broad and have a lot of components. We could say in client engagement acceptance, planning, risk assessment, test of controls, substantive procedures, audit conclusion, audit reporting. That can be a really, really broad area. When I talk about phases in audit testing, this is the point in time where we start gaining something called assurance. Now, you probably heard that term assurance outside of the context of this course. We already have exposed ourselves to this idea of assurance already. Remember those 3 circles that we looked at? I said that actually, I guess they're ovals, okay? When you're my age, everything's a circle. But yeah, they're ovals, okay? And the biggest oval was assurance. But the idea of assurance is basically anything that provides additional value, any information that provides additional value. So say for example, okay, I really want to go to this restaurant, but I'm not sure if it's going to be the food is any good. Could you gain assurance about whether a restaurant has good food? Well, the first way you should say, I go to the restaurant and try it. That'd be one way. Is there a way to do it without going to a restaurant? Get on Yelp, okay? It says food is lousy. Do not waste your money. It's like, okay, dodge the bullet there, all right? So there are many ways of gaining assurance. Basically, assurance just provides valuable information for us. That's the idea of this. We can gain assurance through a number of different phases of the audit. Assurance is basically one of our goals in audit. Is we want to gain assurance. We want to gain information and try to improve our decision-making process. Well, preliminary risk assessment or our risk assessment process is basically what I call our first point in gaining assurance. So I call this the first phase in testing. Now, just for context, there are going to be 3 phases that we're going to be talking about in testing. Risk assessment will not be a major phase. Our 2 major phases will be test of controls and substantive procedures. But the reason that I'm going to talk about this is because we can collect some evidence during risk assessment. And it's important to understand what types of evidence we can gather. So I want to preface this because I'm going to have a lot of information thrown at you in chapter 5. Chapter 5 is kind of the cornerstone chapter of this particular course. I'm going to throw a lot of information from you, and I'm telling you right now, not next Monday, but the week after Monday when we do chapter 5, you're going to be really overwhelmed, okay? So I want to try to get some of this set up right now so we actually have establishment. So let's go ahead and talk about types of evidence that we can collect during risk assessment. All right. And there's going to be three that you should become very familiar with. Inspection of records of documents related to the operations of the clients. So this is going to be business records, okay, accounting records associated with the client. We can also perform observation of personnel and processes. We can go talk to people. We can probably perform inquiry of people within outside the entity. Now, I want you to make a note of this, and I'm going to see if somebody remembers this a week and a half from now when I ask you this on Monday, okay? These are called the big three of evidence. That's what I call them anyway, the big three of evidence. The reason why is that you can use all three of these types of evidence in every single phase of the audit. So if I ask you to give me three forms of evidence you can perform in risk assessment, you should be able to blurt out these three, okay? Say, inspection record documents, observation, inquiry, Dr. Barnes. And I say, all right, give me three types of evidence you can collect during test or controls. You should say, inspection record documents, observation, inquiry, Dr. Barnes. And I say, all right, give me three types of evidence you can collect during substantive procedures. Guess what? Yeah, these three. These three will always be present. They're our most versatile forms of testing. So we can perform testing of this in risk assessment. It's also important to note that we can perform preliminary analytical procedures. Our second half of chapter 5 is going to focus entirely on discussion of analytical procedures. We don't need to get too much in detail about what they are now. Basically, analytical procedures are kind of shortcut procedures that we can use to gain assurance. Preliminary analytical procedures are required under PCAOB standards. We're going to talk about that a lot more when we get to analytical procedures in chapter 5. We're going to see that there's three times during the audit that we can use analytical procedures. This is one of those times that's actually required. There's a second time that's also required, but three times that we can actually do that. Don't worry too much about the requirement now. Just make note, we do have to do this testing during risk assessment. It's called analytical procedures. You'll become very familiar with this over time. Trust me when I say that. Okay, so some of our evidence, we got a lot more types of evidence to gather, but I want to make sure that we know these four right now. We're going to come back to these in chapter 5, and I say, do you remember this? And everybody should be like, yes, I remember it completely, Dr. Barnes. I took your advice seriously. Or you're going to be like, no, we went to Labor Day and we completely forgot it. One of those two is going to happen, okay? One of those two is going to happen, but that's okay because we'll revisit it again. So in evaluation of the risk assessment process, so this is something that's really, really important. So keep in mind that an entity has required to identify risks and respond to those appropriately. And we don't use that term in this slide, but I think that you all know that term. What do we call a response to risk again? Control. They have to implement controls, okay? If the entity's response to the identified risk is adequate, then we can actually reduce the risk and material misstatement. In other words, if they have good controls, we could reduce control risk and thereby reduce our risk and material misstatement. What about if their controls are bad? Then we may have to actually increase risk and material misstatement and increase the level of our testing. So that's basically in a nutshell what we've talked about before. Now, what does that contain? How does that mean? We're going to talk a little bit about that representation when we get to chapter 5. We're going to talk very heavily about that representation when we get to chapter 6. We're going to revisit the audit risk model, and we're going to say, how do controls play into this whole thing? An auditor has got to make a lot of decisions with respect to controls that actually facilitate their decision to make choices about what control risk is going to be. Once they establish control risk, it actually dictates the scope of the rest of the audit. Okay, so sequential process important to this slide is basically saying, once we establish controls, we establish our risk and material misstatement. Risk and material misstatement establishes our detection risk. Detection risk establishes our remaining procedures. So I don't know why this slide is in here, because this slide is just repeating everything we just said previously. I guess it's just a reiteration. I felt like reiterating those points. All right. Last thing I want to talk about with respect to this chapter is the risk and material misstatement. But you know what? We've got 1 minute before you all have to leave for break. So that's going to be continued when we get back on Wednesday. On Wednesday, we're going to talk about the nature of risk and material misstatement. We're going to talk about categorization of risk. We're also going to have a little fun activity that I hope you will all be here for. So have a good break. I'll see you all on Wednesday.